thank you very much to everyone who's joining and participating in this webinar. As we wrap up the year, we're very happy to share the results of our latest report that has been powered by SHUAA, focused on the sentiment of venture debt here in the MENA region. This year alone, we've heard of many investment rounds that have happened for the likes of Anghami, Pure Harvest, Tabi, Tamara, and the likes. And really, in the last 18 to 24 months, this has really become an instrument that people have started discussing here in the region more and more. And yet, on the global scale, it is something that is already widespread in many of the startup scenes that exist. But now we're really seeing the emergence here in the MENA region, if not the wider emerging venture markets. I'm very happy to have Natasha Hannoun, who's joining us today as head of debt from SHUAA Capital. So Natasha, thank you for joining us today and getting your insights. The idea of what we're going to do now is I'm going to delve a little bit into the results of the report, share some of the slides and the key takeaways for no more than 5-10 minutes. And then really, it's going to be a fireside chat with Natasha on venture debt. And then I'll be more than happy to open it up to the wider audience to see if you have any questions. This is being recorded, so we'll be able to share this afterwards as well. Just to jump into the presentation a little bit. I mean, venture debt, as defined as part of the presentation, really is a type of debt financing instrument for early stage and growing companies, where it's typically used to complement equity in terms of venture financing to help further accelerate the growth of many of these companies. And really, when I asked Natasha some of the questions, it's to try and demystify some of the reasons startups in the region may be interested in this. But to put this into the context, while we're currently as MAGNiTT aggregating data on venture debt, and I believe we have something close to 120 rounds that we've aggregated to date and hope to be sharing in the platform and research next year, we wanted to put it in the context of some of the US markets. $25 billion worth of venture debt was raised back in 2020. And that goes back 5x from 2010. And yet, when you look at the kind of stages that this capital is being deployed into, it continues to grow at angel stage, early stage, as well as kind of late VC. So a mix of the type of companies that are raising this in terms of capital for the size of deals of venture debt. Yet when we did the survey, which was focused here in the region, we did 110 responses, 40 coming from investors who had on average 13 different portfolio companies and 70 plus startups that had already raised on average $7.5 million worth of funding. So relatively established companies. And the idea was to target those companies to get their opinion rather than those that hadn't raised funds already. And as you can see from the mix, predominantly from the UAE and Saudi, but across the wider region and in the investor landscape, also around 30% that are coming from outside of the region. So what were the key takeaways? The report, for any of you that haven't downloaded, and we can share the report with you afterwards for you to download, was basically built around a sentiment report. Get their insights and thoughts around three key areas: their familiarity with venture debt as an instrument, their appetite for venture debt, and what are the key considerations that they had when raising venture debt here in the region. And there's a lot more detail in the actual report itself, but we thought, let's grab a couple of the key highlights that we can discuss with Natasha as we go through the presentation. So with regards to familiarity, interestingly, in both cases of investors and startups, over 97, 93% in the case of startups had heard of venture debt as an instrument. But interestingly, 74% of those investors had a strong understanding, highlighting that investors seem to be more familiar with venture debt as an instrument, whereas 58% of startups founders had a rough idea of what venture debt is. And I think that's because it's still relatively new as a product, and there's still a little bit of education that needs to be built around that, hence the need for this type of report and transparency around the product itself. When we looked at how many of them had actually raised venture debt, only 31% of those that we had surveyed, of the 70 startups, had actually raised venture debt, and 75% of those had raised an amount less than $5 million. So actually, it's still quite limited in the actual use of the product here in the region, and the amounts are much smaller than those that we saw in international markets. When we spoke to the investors, though, interestingly, 74% of those that we surveyed had at least one of their portfolio companies that had used venture debt as an instrument. Now, many of these investors may have co-invested, and therefore there may be some duplication in that. But interesting to note that across the board of investors themselves, 74% of them had at least one startup within their portfolio that had raised venture debt, 54% of which had raised an amount less than $5 million. So not completely uncommon as an instrument across the space, although room for growth and appetite for the actual instrument itself. When we talk about the appetite for future use of venture debt itself, 71% of the respondents had previously considered the use of venture debt. So 63% of the investors would consider using this for their one of their startup portfolios, and 77% of startups would consider this in terms of future use, showing an increase in the appetite for the product itself. Interestingly, when we asked them what was the key consideration for this, 50% of both startups and investors ranked financial performance as the most important strength for why they would get or use venture debt. And I'll come on to ask Natasha why that's important in terms of the product. But then when you delve a little bit further, people actually try and understand whether it's the stage of funding that is important when considering these startups from that perspective. Cost of debt, and we'll delve into what exactly cost of debt means for startups, was clearly the highest ranked factor as to why people would be considering or need to be aware of raising venture debt in terms of the instrument itself, while non-dilutive capital, collateral requirements, and time to raising the actual product itself were key considerations when raising venture debt versus equity. And so en masse, 80% of those that we completely responded said that they would raise venture debt as an instrument in the future, and 50% of investors said 2 or more of their portfolio companies planned on raising venture debt within the next 2 years, which shows a real big growth in the appetite for the product compared to the historical figures that we've already tracked. And the final one is, when raising funds in general, what are the key considerations of these startups and investors? I found this to be quite interesting, and I'll definitely pose it to Natasha. 72% of the respondents said that they would, as we said, look at doing a part equity, part debt round. But 13% of startups considered venture debt alone as a potential round raising mechanism. And 24% of startups said that they would only do an equity round, while 13% of investors would consider only equity rounds for their portfolios. To close this out, clearly we were trying to understand what the ways that different startups and investors would go about raising rounds. 100% of investors preferred warm introductions compared to cold introductions, whereas 87% of startups considered the same. But interestingly, when you delve into the nuances of some of the other questions, investors tended to prefer to meet startups face-to-face, in person at investment events, whereas startups seem to move towards direct on website platform applications versus in-person events. And finally, in terms of why they're raising capital in the first place, investors tend to move towards working capital being the most important, and the hiring of workforces being key factors for raising funds. But those also considered from an investor perspective, capital expenditure, while research and development featured slightly lower down. And interestingly, startups valued acquisitions more than investors do in terms of the reasons for raising funds. So those are some of the factors that we considered. And again, thanks to SHUAA, who powered the report, and for the whole of the team. I think it has been a really interesting journey for ourselves as MAGNiTT, taking some of the insights from the report and what was driven. Something that I remember speaking to Natasha when we formulated the report and said, look, I'm one that's still learning about this product, and I think this is extremely important. So thank you very much for powering the report itself. But I mean, I guess, let me start, Natasha, firstly, thank you for joining us. But what were your kind of key takeaways of the report itself, and some of the things that it brought out for you that excited you moving forwards?
I think the key thing really was the report sort of confirmed our belief in terms of what was happening to or for startups here in the region from an availability of capital perspective. We've spent quite some time looking at the ecosystem, speaking to founders and speaking to VC firms, and we've identified that this was potentially a space and a segment where there was a very big gap. So the survey really confirmed that fact, which, you know, as you said, the majority of people that were surveyed did intend to raise around in the next sort of 12 to 24 months, and that really just sort of supports our thesis. I think the second thing which was quite clear is, as you said, this is a very nascent asset class in the region, and I think a lot of time is going to have to be spent on I guess educating a little bit what venture debt means, what the differences are, particularly in the context of cost of debt being the most important thing to founders, which you know I can understand, because when somebody comes and offers you funding and says, yeah, but you're going to have to pay me X for this money that you're borrowing from me, it's this sense of you know, wow, that's a lot of money I'm giving away. But it doesn't seem to be put into the context of what the alternative is, which is over dilution and potentially raising too much equity that is giving away too much of the founder's upside. And that's where we sort of see the advantage of venture debt coming in versus equity.
So, I mean, there's a lot to unpack there. Let's just start off with, like, what type of company should be interested in raising a venture debt round? I mean, we saw a little bit of that. Financial stability was the key concern for many companies, the stage of the company, and etc. But for you, and let's start off by saying that SHUAA is essentially a provider of this type of instrument. What kind of startups would you be looking at in terms of the first filter?
It's an interesting question, and I think for me, really the key thing in terms of the criteria that we look at when we're speaking to founders is three things. The first is the management team. I think it's very important for companies to have the right management team to be able to deliver the business plan that they intend to. The second is revenue generating. So these businesses do need to have a proven product market fit. You know, at least from our perspective, we come in a little bit later than your seed and early stage investors, and we want to invest in businesses that are growing and they're just looking for scale up. So revenue is another thing, and I think the third thing, which is very important, is positive unit economics. Because ultimately that's what we're relying on in terms of the ability for this business to make sense. The other thing, which I think is an interesting consideration, you know, and maybe this is something that you were going to ask anyway. This is not, venture debt is not a replacement for equity. And for us, it's quite important that these businesses have completed an institutional funding round prior to coming and raising debt. And the reason for that is twofold. I think the first is it demonstrates the stage of the company, to be able to get a VC to invest sort of pre-screens in a way. And I think the second reason why it's important, or the second reason why it's important that there is equity in that business, it also shows that, you know, debt is not an alternative. We're not looking to replace equity. It should be seen as a complementary mechanism within a capital structure, the same way any other business would look at it.
And is there a benchmark proportion of equity debt that makes sense for a company if they're raising a round in terms of what they're trying to do? Is it 1-for-1, 2-for-1, or it really depends on the business?
I mean, usually, if you look at most of the businesses globally, the average that you would tend to see is about 1/3 or half of the equity that had been raised in the previous round is what is raised as debt. And the reason for that is you don't want to over-lever the company, right? You don't want to be in a position where the businesses are struggling to service and abide by their obligations under these loan agreements. But at the same time, it's extending that growth and that runway for companies.
And so if we want to be absolutely transparent for anyone that's watching this that may not be familiar with this, what are the risks associated with taking a venture debt round? Like, what should you know going into this that you should be aware of in terms of potential risks?
I think the biggest risk ultimately is losing the company. So given that most of these businesses don't have collateral which they can provide against these loans, typically what will happen is that the whole entire business is being provided as security. And the way that we look at our investments is how much is this business going to be worth in a sort of in a downside scenario. So I think for me that would probably be the biggest risk that I would flag up front to any founder that I'm having a conversation with, is that if things go bad, you could lose the business. But I think at this stage, if things go bad, then there probably isn't too much to lose anyway.
Yeah. But just one thing, actually, it's important. I mean, there was a lot of discussion in the midst of COVID last year, or we're still in the midst of COVID, but in the midst of the pandemic, when we were deep into it last year, where there was discussion of trying to provide venture debt as an instrument to support struggling startups. I mean, I really want to demystify that logic at the time, because it really made no sense to me. Because if a company is unable to kind of survive, is venture debt meant to be an instrument to help companies survive? Or as you said, it's really to accelerate and further develop growth while they have unit economics and they're in a comfortable situation?
I mean, there's two things, I guess. One thing is obviously venture debt can act as a catalyst and an additional capital for you to be able to accelerate growth and extend that runway for businesses. But I think the other part, which is important, is it does also provide a buffer, right? Where these businesses can cash up a little bit more than they would necessarily do if they were raising an equity round, because you don't want to give up that extra 1%. And the amount of funding that you need is 10 million to deliver you a certain amount of sales. So that's your target, and that's what you're going to go out and raise. And having this venture debt just gives you that buffer. So I think in a way, what they were talking about is venture debt as a solution. It does provide that additional room and availability for businesses to, how can I say, wait out these external factors that might affect the business, that might not be fundamental to the actual successfulness of these companies.
Understood. And again, hypothetical, because we didn't get to speak to actual investors, albeit that the responses provide us some color. There's some that say that why would a VC be interested in their startup raising venture debt? Because it's almost competitive to them providing further investment for them to get a further increase in their share or proportion of the company. Do you understand that logic, or is that logic somewhat flawed?
It's somewhat flawed, and I think the reason for that is, if you look at re-ups that VCs do in companies over multiple rounds, they're always part of it, and they have the ability to participate so as to limit the amount of dilution. But ultimately, if you provide these founders, these investors, a solution that is non-dilutive, I don't see any reason why they would have any objections to it. Really, the way that we're looking at this concept, and a lot of the conversations that we've had with the founders have been, we're at this stage now where we have product market fit. We're trying to gain market share, and we want to be able to grow faster, and we need that capital. And what venture debt is able to do is able to provide them with that capital, where they can utilize the funds as and when it is required. So they have a commitment, but they're not necessarily negotiating any valuations or anything along those lines. And what effectively happens is when that capital becomes required, they can draw down on it and they can utilize it. And then you go out and you raise that equity once you've reached a much larger milestone, which allows you to achieve that higher valuation. So from a VC's perspective, it's a win-win really, because you know, they're benefiting from that multiple growth on revenue growth.
Yep. And if we look at industry specifics based on your experience and international, I mean, we've only seen so many limited cases here in the region. Are there any industry trends in terms of certain type of industries are proven to be more applicable for venture debt, SaaS type businesses that have recurring revenue, or is there anything that we can speak to that may be a future trend for the region that we haven't identified yet?
You know, I mean, I think it's easy to sort of look at what's happening internationally and say it's the same thing here, but I think it's really just kind of where a lot of the institutional venture debt providers have looked at investing, and as you rightly said, SaaS is one of them because it's that predictable cash flow. The other one where we're seeing, you know, where there has been a lot of investment as well on the venture debt side is anything that has a lot of technology or IP related substance behind it. So the biotech, etc. type businesses, there's a lot of venture debt funding there. But you know, for me in the region, if we look at where the venture ecosystem is, we're still a little bit behind where the US and the rest of the world is.
We're not very far behind.
Not just on the debt side, but also in terms of the stage of the companies. And that's why I think the growth potential and the opportunities here are not necessarily going to be exactly the same as everywhere else globally.
And interestingly, to that point, I mean, do you, for the audience and people that may watch the video, can you name any big international brands that have used venture debt for their growth that you could relate to, or people could kind of investigate a little bit further?
I mean, if you look at a lot of the big unicorns, the Uber, Spotify's, Airbnb, Baidu, they all have venture debt as part of their cap table. Now, when they raise that capital is sort of a different discussion, but they have utilized venture debt in order to fund their growth. Another one more recently actually is Bolt. I think they announced a 50 million euro financing from the European Investment Bank sometime last year, probably just around COVID. So there are quite a few success stories, and I think, you know, what needs to happen here is businesses or founders, at least from my perspective, need to look at their capital structure and understand what is the optimum capital structure for me to be able to grow my business. You know, VCs, they sort of follow the Pareto principle, which is 20% of the results is going to, 80% of the results is going to come from 20% of the investments. And as a result of which that basically means their focus and the attention on the investments that they're making maybe are not necessarily the same as someone that is investing venture debt, right? So when a founder is going to pitch to a VC, they're pitching, hey, I'm going to become the next unicorn. But when we're looking at a business, we don't need it to be a unicorn. We just need it to have that scale up ability.
Recurring, yeah.
Exactly, and that route to profitability. And I think that those are the key things, and it's important for businesses when they're considering raising venture debt.
Is there anything a startup needs to be aware of from a regulatory perspective? I mean, is this a regulated instrument? Is this different per geography? If somebody's sitting in Saudi Arabia, Abu Dhabi, Dubai, or any of the geographies here in the MENA region that they should be conscious of?
So I think alternative financing and alternative lending is still sort of, there's no specific regulation around it. lending as an activity is regulated everywhere in the world, but you do have non-bank or non-regulated entities that are providing loans and that are extending financing. So I think within specific regions there will be nuances. I can't really comment on all of them, and I don't really necessarily think it might be interesting for this discussion. But I think at the end of the day, it is just another form of investment, and the way that these tend to be structured is either through a note issuance. The only difference is that these are non-convertible notes; they're redeemable ones, or through a traditional sort of straightforward loan type structure.
And we've heard of one or two providers here in the region. I mean, whenever we speak about investors, one of the biggest recommendations to founders is that they need to do due diligence on their institutional investors and work out their backgrounds, their portfolio companies, et cetera, et cetera. Does the same logic apply, or for venture debt providers? What is it that you should potentially be looking for? And a second part of that question, one of the questions that we asked in the survey is, what value add does an investor give? So in VCs, a lot of people go to them for their networks and the like. Is that intended to be the same for a venture debt provider, or is it purely take the cash and make sure you hit the milestones?
I think different providers have different approaches when it comes to their investments. For us, we do have a very hands-on approach, and the reason for that is that we obviously understand that businesses need capital, but also there is much more that we at least feel that we can add to the businesses that we're investing in. So the fact that it's invested as debt rather than equity doesn't really change that, and we want to make sure that the companies that are accessing this debt financing are getting the most out of it, and whether that's through support on the board, help with further funding rounds, and ancillary services, for example. So us as SHUAA Capital, financial institution, there may be potentially businesses that would require legal support, compliance support, etc. It's something that we would be willing to consider and to offer. The other part for a lot of the other, call it venture debt, or more generally venture debt providers, I think the answer is it really just depends on the founder and on the investor as well. You'll find both ends of the spectrum, where you have those that are quite involved and those that aren't.
I want to make sure that we allow some time for anybody that has any questions. So if anyone has any questions, please put them in the chat or in the Q&A and we'll get to them. SHUAA Capital, let's speak specifically about what it is that you're looking to do. In 2022, this space is interesting for you. Can you share any color on what it is that you would like to support the ecosystem with?
So we've sort of been alternative providers or alternative lenders in the market for quite some time now. And we've been following the venture debt space quite closely. And the reason for that is obviously with the move towards digitalization, with all of the government initiatives relating to diversification away from oil revenue, etc. The space is becoming much more active, and businesses are, or at least the startups that had started about 5 or 6 years ago, are now at a stage where they really want that firepower behind them, and we're looking to be that provider of capital. So our intention is to focus on growth stage businesses that are looking to raise tickets of between $10 to $25 million.
In venture debt, not equity. Okay.
In venture debt, exactly. With an idea for this to sort of push their growth and extend their runway over the next few years. We're sector agnostic. We're looking at all of the spaces. There are some, as you say, working capital was one of the key requirements that a lot of the businesses had. So a lot of the opportunities that we're seeing these days are fintech companies. whether it's some shape or form of financing, where they're looking to include a form of debt within their balance sheet. The other space that we're seeing a lot on is businesses that have a little bit more capex or spend on assets that you wouldn't normally expect. So take Pure Harvest as an example. There are quite a few other businesses now in the space that they are offering the asset as part of the overall proposition. So we're not just looking at technology companies, we're also looking at technology enabled businesses. So I think businesses that have high capex and they're looking to increase the amount of assets they have on the balance sheet. This is also a very good solution because, as I said, it's non-dilutive capital, and as a result, it means it's cheaper.
As we said, that there's still kind of a bit of a lack of education around this space. I mean, do you have any recommendations of places where people can find information? Are you guys going to be doing anything at events or things in 2022 where people can gain information? Or is there a point of contact if a startup is just interested to learn a little bit more that they could reach out to?
I think all of the above. In terms of sources of information available, there's plenty online. There are a lot of good articles and reports that just talk about what venture debt means, what are the risks to founders, how is it different to equity being raised, advantages, disadvantages, etc. And from a SHUAA perspective, I think we are looking to host one or two events potentially just to focus on elaborating a little bit more about what a venture debt structure looks like, what founders would be required to provide, process, etc. And obviously we're always available and we're always happy to speak to founders just to answer some questions and clarify anything. Great.
Again, if there's any questions that anyone has, please take the opportunity now with Natasha on the call to put them through on the chat. And just from one point that we mentioned, that we said X, Y, but I think in the interest of transparency, when we talk about the cost of debt, what is that? I mean, for someone that's looking to raise, we don't need to talk about SHUAA specifically, but what's the typical range of raising a round that someone should be conscious of when they're raising a venture debt round?
I think typically if you look at it, it will probably be somewhere in the mid to high teens. And then what you also tend to see with venture debt is some form of upside sharing in the form of warrants that can be exercised at the option of the lender. So that's sort of the return hurdle. How that return is achieved. What tends to happen is that you'll have a cash paid portion, and then you'll have something else that's maybe rolled up and just payable at maturity. So again, like I said, it really depends on providers of capital. I think
what's a typical tenure for the note? I mean, it's a.
So I think the way we're looking at it, at least, is that this is a short to medium term funding solution. So it's about call it a 3 to 4 year tenor on these financings. And like I said, Philip, I think the purpose of this is really just to, it's like, I guess the way that we look at it is an alternative to a bridge round or an unpriced round. And it saves the company and the founders the headache of having to go and pitch to 150 different investors. It's one provider that can give it to them. There's no discussion around valuation. Convertible notes. I know everybody's doing convertible notes and safes now, but even those you've got caps and floors that are part of it, and that does affect the fundraising journey of these businesses. And what we're trying to do is just take all of that headache away.
And interestingly, I mean, as someone who's fundraised but speaks to a lot of founders, legal counsel is essential. Is, I assume, exactly the same for venture debt, but do you have standardized notes, or is each one meant to be a negotiation mechanism in the same way as kind of a Series A, Series B round?
It's a very good question, actually. One of the biggest issues that we were facing when we were looking at this is the legal costs, because the documentation is quite substantial and is quite important and fundamental to these types of deals. But what we have done and what we've managed to do is get a standardized set of documents. Now, of course, they will have to be tailored for each transaction. Not everybody has the same requirements, and all businesses require different types of flexibilities. But ultimately, what that means is it allows us to be a lot more efficient with our funding from a timing perspective, and also a lot more standardized and easier for founders.
Manish asks an interesting question from the audience. What would be the process of seeking discussions to evaluate options for venture debt? And I'll take that a step further. What is the process? As in, I'm interested, we have a conversation. Is it like pitching for investment, pitch deck and conversations, or what is the actual process from I'm interested to potentially closing a round or a note?
So I think where it starts, I guess, is number one is the venture debt provider. So you have a list of all of the people that are willing to and able to extend that financing. The second is, as you rightly say, most people, the process will be very similar to an equity funding round. And that's why a lot of the time it makes more sense for you to do it in conjunction with an equity raise, because that information is already there, it's available, and you're going through the process. So it just means you're doing it with one other person. But the type of due diligence which is conducted is very similar to what you would expect under an equity round, which is need to understand the business model, need to understand the forecasts and the business plan, the unit economics, key risks, competitors, the same, I guess, the same things. 5 or 6 things that you would be discussing with VCs. I think the main difference that you would probably see with venture debt versus venture capital is you tend to have a negotiation and you have a lead for that round, and then you go and get your followers. On venture debt, it tends to be one provider. So you don't need to do that follow-on round. So what that means is, you'll be negotiating the terms, and then once those terms are negotiated and agreed, that's it, the funding's there, and you sign on the dotted line and that cash is available to you. From a timing perspective, I'd say it could take anywhere between 8 to 12 weeks from start to finish. That's
considerably shorter than 12 months or 9 to 12 months, which is a typical investment round for equity.
Yeah, and it does depend on how prepared the company is for that. So an investor presentation and a fully operational financial model are 2 very fundamental things that without which you're not going to be able to raise any venture debt.
As well as audited financials? I mean, is historical financials also important?
Historical financials is important. I think audit just shows that kind of governance and controls are in place, and the right discipline. I think how important is it to evaluating the opportunity? Not so much, because ultimately we're looking at the growth of the business, because we're fully aware that all of the companies that we're looking at are pre-earning. So loss-making companies, and they are likely to be loss-making for the next at least 2 years. So what we do is the historical is less relevant. I think the relevance is maybe on the growth, and number of users, GMV, etc. Those types of statistics are important, but your balance sheet and things like that, not so much.
Again, if anyone else has any questions before we close out, please feel free to put them in. I mean, just taking a step back, because I've seen you now at a few conferences that I've been attending, and there's a lot of activity that's happening in this space, and I think it's great. We've talked about venture debt. Are there any other instruments that are worth noting? I mean, you mentioned obviously you are participating in the SPAC exercise with Anghami. Are you seeing that as the ecosystem continues to mature, not only venture debt, but there'll be other opportunities for new instruments to continue to develop here in the region, and which ones you think may become popular?
Yeah, of course. It's funny you say that. I think for us, what we're noticing is that the venture ecosystem is growing faster than the capital that's supporting it. So you know, people are sort of playing catch up, and whilst you do have a lot of institutional investors now that are putting big money behind VC in the space, whether it's seed or early stage, you know, we need to start to see more investors in the growth stage that are able to write big tickets to continue to support the growth of these businesses. And where we think venture debt becomes interesting is that can potentially become that solution, right? Where a business comes and raises $10 or $20 million, they achieve their certain milestones, they come back and they say, you know what, I'm not going to go and do another equity round. I'm on the path to profitability. Maybe I will raise a smaller amount of equity and take on some additional debt in order to grow the business. And then we can look at, through our investment bank, and as you say, various instruments, look at de-SPACs, look at potential listings on regional markets, whether it's through Nemo or somewhere else, but be able to support that business through exit. Because I think ultimately that's what the founders that's what the goal is, right?
Yep, that's the
monetization of all those tears and sweat. So,
yes.
And we want to be part of that journey, and we want to be able to support that that growth of the business from where they are today to the ultimate exit.
And I'm going to pick up on what you just said, because I think it's very interesting for me personally. What makes you think that there is a lack of capital for the growth of the VC activity that's happened, or the growth of the company? Like, what is it that you can point to from that perspective? And then to flip it on its head, what do we need to catalyze both venture capital and venture debt in the region? Is there something that can happen, or is it just time, patience, and success stories that further encourage more capital to come into the region?
I definitely think it's time. That's very important, because it is a growing economy. I think and it's natural to start to see money flowing in from other places, and they will do that when it becomes large enough for it to become interesting. And I think maybe for now, despite the numbers which were announced in terms of the total number of transactions which have been done first 9 months of this year, which is a record amount, it's still very small compared to the rest of the world, right?
But I did a report in Abu Dhabi. Total amount of capital in MENA is only a fifth of the total amount of capital that was deployed in LATAM, and that was the next largest market. So we're definitely far behind many other markets.
So I think as the businesses grow and as they move through, it's important. I think the other thing that's happening, and you mentioned this, founders are becoming, it's no longer about the highest valuation and who's going to pay the most. It's about who's going to be the partner that can provide the most value for me to be able to achieve my objectives. And what that means is the founders are the ones that are deciding who are investing in the company, and it's no longer the other way around. And that power shift is moving, and I think that's something which is quite important, because people are going to have to be able to offer something different in order to compete in this space.
Great. Look, anything else that you would like to share before we close this out? On any predictions for 2022, actually, which I commonly ask when I'm talking to VCs about 2022 as we close out the year. Any predictions in the overall ecosystem or in the venture debt space that you anticipate in 2022?
I think it's going to be very exciting, to be honest. I think we're going to see more exits, which is, something that is important, and it's part of that story that a lot of the founders need, that hope that they need, that they're striving towards. So I think that's one thing which I'd probably expect for 2022. And I think the other thing that we'll start to see is I don't know, actually. So I didn't really think about my predictions, but I know it's going to be a busy year. I think it will be better than 2021 for sure.
Well, 2021 is shaping up to be a record year by all measures, so it'll be very interesting to see. I mean, on a final note, and selfishly asking as MAGNiTT, because we will now be reporting on Africa, Middle East, Pakistan, Turkey, and going beyond MENA. Is your remit just MENA, or are you looking at these opportunities that exist across the wider emerging market space?
MENA is our focus. As SHUAA Capital, our ethos or our philosophy has always been reinvesting in our local economies, and that's something which is very important. You know, homegrown brands, homegrown founders, supporting the business and the growth of these new economies where we are is fundamental. So I think for the time being, it's going to be MENA.
Great. Well, I think we'll be, if you ask me, I'll be very excited to see many of these African, Pakistani, and Turkish startups coming to MENA. And I think that if I see one opportunity that will exist is we'll no longer be talking about a MENA market, but a kind of slightly wider one where startups are going to start moving as they continue to scale and grow to get to exit. Thank you very much, Natasha. It's been an absolute pleasure today. And thank you for obviously powering the report and the insights from the report. I think they're extremely exciting. And I think soon you'll start seeing us and yourselves sharing data on the level of transactions and activity that's happening here in the region as it continues to become an actual asset class, which again, for full transparency, we don't include in our reporting because it's not equity exchange. It's a completely different instrument. Other people seem to couple it together. For us, they're completely separate instruments, but it's got to a point where the activity has become so significant, it's almost worth having a specific section on it itself. So we look forward to seeing how this develops into 2022.
Thank you so much, Philip.
Thank you, and a Happy New Year, and Happy New Year to everybody who's attending. Thank you very much.